Unless you live under a rock, you have been inundated like I have with ChatGPT, OpenAI, AI this, AI that, AI everything. On top of all of the chatter and news and Twitter posts about AI, there has been a tremendous amount of money flowing from venture capitalists into AI startups at eye-watering valuations. Now, there's no question that AI is going to fundamentally change our economy, how we do business, our daily lives, kind of all aspects of our lives. In fact, just recently, Alan Patricof. So for those of you that don't know who Alan Patricof is, he is like one of the OGs of venture and private equity investment. He founded Apex way back in the day, which is one of the largest, most successful private equity funds. And then because that wasn't enough, left that and started Greycroft, one of the leading venture capital funds out there. And so, from the time he started investing back in the 70s, he's seen the advent of the computer and the semiconductor and biotech and the internet and mobile devices and social and all of these different trends. And he recently said that AI is the most impactful, most important change that he's ever seen in his career. And the potential of it is just truly mind-boggling. So what does that mean as a venture investor? Well, AI represents this massive opportunity to make a ton of wealth. It will be one of the largest drivers of wealth, I believe, over the next probably decade. Although the speed of innovation is so fast that there's going to be a lot of money made every year during that decade as we see seismic shifts in our economy and how work is done. What this means as a venture investor is that it's a great time to be investing, and you need to be looking at AI seriously if you want to participate in this massive wealth creation. That said, I wanted to take a minute in this video and talk about some of the pitfalls that I think a lot of investors are going to fall into if they're not careful, and how you can be smart about making investments in this space if that's the route you want to go, or as a founder in the AI space, of pitfalls that you're going to want to avoid as well. And be sure to stick around to the end because I'm going to talk about my number one biggest fear and pitfall that I think is happening right now as we speak. Okay, so the first pitfall you need to watch out for is what I call AI wrappers. Now, this is a company that is touting that they are AI, that they have something proprietary, but in reality, they're just a wrapper around ChatGPT or somebody else's platform. Now, on the one hand, this can be really powerful because you can leverage their generative AI models to quickly solve problems that people face every day, right? And you can get real niche focused into creating a really great user experience for those customers that allows them to leverage the power of ChatGPT. The biggest problem with this is that it is this like age-old problem of building on somebody else's platform that you've got to be really careful about because you don't really know what direction ChatGPT and OpenAI are going to go with their platform. And it very easily could be that they make changes to either come after you in your space specifically, or they make changes that benefit them at your expense. A classic example of this is Facebook and Zynga. So I don't know if you know the company Zynga, but back in the day, it was like a powerhouse for online social gaming. It was really like the first big unicorn around social gaming. They launched games like Farmville, Words with Friends, and a bunch of others. Well, they were built on Facebook's platform, and the real magic was that you could go on, you could create your farm, right? And you'd go on and you'd do different things on your farm to generate crops and sell those crops and build out your farm and so forth. But it had this social element where you could play with some of your friends. And so you could, see what they were doing with their farm and you could trade goods and all kinds of stuff. And so it had this very strong social component. It also made it really easy to log on, create an account. All of it was actually hosted on Facebook's platform and enabled Zynga to grow incredibly fast. Well, fast forward, Facebook decided to cut off a bunch of the functionality for Zynga, basically booting them off the platform. And overnight, Zynga's entire business went sideways. And they had to quickly spin up other websites, try to convert customers over to their own platforms, their own sites, their own apps. And it was incredibly damaging to the business, largely because they were so reliant on Facebook. And so I think that's one thing that as an investor, you got to be thinking a lot about is if I'm going to invest in one of these companies that's simply, a wrapper around ChatGPT with a really nice, pretty user experience, is that going to eventually be able to become a really big standalone business? Or is it just something that's going to be always kind of be reliant on OpenAI to succeed? I think the truly innovative companies will be the ones that build their own AI engine or have some sort of proprietary partnership or what have you that gives them, a real competitive advantage on that front. Those that are really dependent on other people's platforms are really going to struggle. Now, if you are built on somebody else's platform, what should you do? My advice there is hone in really hard on your user experience, because a really great user experience can create some barriers that will provide some differentiation and benefit that is harder to replicate. I think a classic example of this is why Spotify still exists despite all of the advantages that Apple Music has. And I think that really comes down to Spotify has built an incredible user experience that's been really challenging for Apple Music to fully replicate. All right, the next big pitfall is the speed of innovation. Classic case study that is similar to this was semiconductor development. Now, back in the 80s, 70s and 80s, a lot of investors, especially venture investors, were investing in semiconductors. And the reason for that was because semiconductor technology, was so important, so high margin, growing so fast that you could invest in a company that was doing semiconductors. They would have some, unique advantage that gave them a boost in performance over their peers and, grow super fast. The challenge is that over time, the speed of innovation just kept accelerating and accelerating, and it became harder and harder to invest in a company, see them grow, and exit your investment before the next competitor popped up and stole all their market share. And so eventually, a lot of VCs moved away from semiconductor because it just became too challenging to make it through your invest and exit the investment and return cash back to investors fast enough before you'd get disrupted by the next up-and-coming player. If you want to read more about that, check out Clayton Christensen's fabulous book, The Innovator's Dilemma. So for example, let's say you've got some really cool video editing technology built on AI that does, maybe it finds you pictures automatically and drops them in, charts and pictures and stuff as you're talking about it in your video, right? That would be really cool. Is it a standalone product though? Or is it really just a feature that eventually Adobe's gonna build into their overall platform? So you gotta be really careful about what you're investing in and truly believe that it can be a standalone company and product and not just a feature of a much larger product. And the problem is, tying this back into the speed of innovation, is that what those things that seem like true products today, as these products, these companies, they grow and the innovation comes out, they could very easily leapfrog those other products and pull them in or provide or create new features that supplant them. But what do you think? Comment below. I want to hear what companies you think are true platforms and real products, and which ones you think are ultimately just features of a much larger product or platform later on. The next pitfall is that if you think about the magic of AI, is that AI effectively drives the cost of creation down to zero. Because if you want to create art, you can just type in a few keywords and boom, you have beautiful art. If you want to create a blog post, you can just type in a few prompts and boom, you've got a blog post. Even if you want to do video editing, right? Adobe's launching all kinds of cool AI tools that drive down the cost of creation for that really low. There are so many things that are coming out that leverage AI to really drive down the cost of content creation or just creation of anything, right? The same thing with coding, app development, websites, right? There are AI tools that will build an entire website for you just by typing in a few prompts. Really what AI does is it drives down the cost of creation. If you think about business in general, it's really a combination of three things. It's creation of some sort of value, right? Could be an app, could be content, could be lots of different things. It could be a widget, right? So it's creation, it's distribution. So getting that product that you made and getting it in the hands of the customers, and then it's discovery. And discovery is all about like helping those customers know what your product is so that, you know, they want it, right? Well, the internet has been incredibly effective at driving down the cost of distribution for a whole range of things down to effectively zero, right? You think about Amazon, right? Amazon distributes almost everything now. You go on the internet and you can find like anything. And by doing that, they've displaced tons of like brick and mortar stores all over the world, right? So the internet has been really effective at driving down distribution costs. Well, now if you're also going to drive down creation costs, what does that mean for your last bucket? And that is discovery. Well, as internet has driven down the cost of distribution, you saw the cost of creation go up and you saw the cost of discovery go up. What do I mean by that? Well, what are some of the highest paid jobs in tech today? It's developers, right? Coders and developers, and it's sales and marketing, right? Sales reps at tech companies can make millions of dollars, and coders at companies can make hundreds of thousands, and in some cases, millions of dollars. I think what's gonna happen is companies are gonna have to spend more and more money on discovery than ever before. And if you go into AI not realizing that that's gonna be like a huge part of the business going forward, you might under-optimize and over-optimize for the wrong things. So another pitfall to think about. Since you're still watching, please be sure to subscribe. It really helps the channel and really helps me be able to get a lot of this content out to more people. All right, the last one is valuations. And I think this is the one that is impacting everybody the most right now because valuations are going through the roof for AI. The reason I think this is a problem is you still have to build a real business around these companies, right? And if you pay too high of a valuation, it makes it really hard for the company to raise more money in the future. It makes it really hard as an investor to generate a good return. And so, you know, we're seeing valuations right now that are even higher than the peaks of what was being paid for in 2021. I think this is driven by a lot of factors. One, VCs still have a lot of money on their effective balance sheets to invest in companies, and they're not really excited about investing in SaaS in the same way that they were even a couple years ago. So I think that's one. I think the other thing is that they're really not excited about any other stuff out there, so that really kind of laser focus them onto AI. So a lot of money chasing relatively few deals. I think the other piece is that I think AI at the end of the day really lends itself to a winner-take-all market. And when that's the situation, it kind of doesn't matter how much you pay in any given deal. All that matters is that you were in the one deal that becomes the absolute dominant player in the space. This is why, like, there's a very good chance that Microsoft's recent investment in OpenAI will be like one of the all-time best investments ever made. The rumors that I'm hearing right now is that OpenAI is nearing or has eclipsed $1 billion in annualized revenue just in the last few months since launching their product. I mean, you think about that, to go from effectively zero to $1 billion in revenue in just a handful of months is like mind-boggling. And so I think you're gonna see more and more of these companies that have really high, fast growth. But if you go back to my prior pitfalls, right? Speed of innovation, building on other people's platforms, and so forth, what's going to happen is there will be companies that grow really fast, but ultimately get leapfrogged, displaced, and VCs that paid really high valuations for those are going to very quickly lose a lot of money because there won't even be like the possibility of a safe landing for those companies because the valuations paid were so high. Anyways, let me know what you think down in the comments. Really curious to get your perspective and thoughts on the impact of AI and what you're seeing. And be sure to check out some of my other videos, like the one where I talk about how Mark Cuban hasn't profited from his Shark Tank investments. Thanks.